friends, welcome to yet another video on SEBI Grade A exam series from Finance MCQ. I am CA Pritam Singh Sangwan and today we will be discussing some important MCQ questions from accounts topic of your SEBI exam technical syllabus. Friends, this technical syllabus is of 100 marks in phase 1 and it has 2/3 weightage in phase 2 of your SEBI Grade A exam. And friends, you can find entire technical syllabus of SEBI Grade A exam chapter wise, topic wise on Finance MCQ website in MCQ question format. You can visit the website and practice entire technical syllabus there. I have put the website link in the description box below. So let's begin and try to solve the MCQ questions along with me. Question 1. Minimum period between date of grant of option and date of vesting of option is option A 3 months, option B 6 months, option C 9 months, option D 1 year, option E 3 years. The correct answer is option D 1 year. Friends, vesting period is time period for which an employee has to wait for granting of shares by the company. Question number 2. Date on which employee purchases the shares is known as option A issue date, option B grant date, option C vesting date, option D exercise date, option E none of the above. So what's the correct answer? It's option D exercise date. Friends, on exercise date an employee is exercising his option and purchases the shares. Question number 3. Dash shows the systematic numerical evaluation of different items in a financial statement for 2 or more periods. Option A vertical analysis, option B horizontal analysis, option C internal analysis, option D external analysis, option E none of the above. So yes, what's the correct answer? It's option B horizontal analysis. Friends, it is a comparison of 2 or more financial statements side by side, and vertical comparison is when you are comparing one line item with another line item. So question number 4. Which of the following is not a type of financial analysis? Option A trend analysis, option B common size statement, option C ratio analysis, option D cash flow statement, option E consolidated financial statement. Yes, what's the correct answer? It's option E consolidated financial statement. Friends, consolidated financial statement is not an financial analysis. It's a consolidated statement of combined group. So remember this point. Question number 5. Financial analysis will not affect the decision making of A. management, B. creditors, C. potential investors, D. stock analysts, E. advertising agencies. So what's the correct answer? It's option E advertising agencies. Friends, advertising agencies are third party and results of the company will not bother them. Question number 6. Liquidity ratio is also known as A. short-term solvency ratio, B. long-term solvency ratio, C. efficiency ratio, D. performance ratio, E. none of the above. So what's the correct answer? It's option A short-term solvency ratio. Friends, short-term solvency ratio shows firm's ability to pay off its short-term liabilities like payment to creditors and bank cash credit or bills payable, etc. Question number 7. Quick asset does not include A. inventory and prepaid expenses, B. cash and debtors, C. bank, D. debtors or trade receivables, E. all of the above. Yes, so what's the correct answer? It's option A inventory and prepaid expenses. Friends, inventory is not considered as a cash and it will take time to sell it off, and whereas prepaid expenses are already paid by the company, hence both are not considered as quick assets. Question number 8. Long-term solvency ratio are also known as A. Turnover ratio, B. Acid test ratio, C. Leverage ratio, D. Capital gearing ratio, E. Utility ratio. So what's the correct answer? It's option C, leverage ratio. Friends, leverage ratio is alternate name for long-term solvency ratio, and this ratio indicates firm's ability to pay its long-term loans or liabilities. So remember this point. Question 9. Interest coverage ratio is also known as A. Times interest earned ratio, B. Times interest covered ratio, C. Interest to debt ratio, D. Interest service ratio, E. Finance coverage ratio. So what's the correct answer? It's option A, times interest earned ratio. Friends, it's another name for interest coverage ratio, and this ratio indicates firm's ability to pay its interest. Question 10. Debtors turnover ratio is calculated using which of the given formula? Option A, total sales upon total debtors. Option B, credit sales upon average debtors. Option C, cash sales upon average debtors. Option D, total sales upon average debtors. Option E, none of the above. So what's the correct answer? It's option B, credit sales upon average debtors. Friends, for calculating debtors turnover ratio, only credit sales is considered and not the cash or total sales. So do remember this point. Friends, if you want to practice more such type of MCQ questions from your technical syllabus, I request you to kindly visit Finance MCQ website. It has entire SEBI Grade A exam technical syllabus in MCQ format, 2000 plus subject wise, topic wise MCQ questions to practice. It has explanations for correct answers wherever required, 25 test series technical syllabus, and each test series are having 20 to 25 questions. So friends, don't miss this golden opportunity and increase your selection chances significantly. Website link is in the description box below, and if you have any questions, please write in the comment box below and I will try to address them, and I will come up with new MCQ questions to practice on SEBI Grade A exam. Till then, take care and thank you so much for watching.